CBN News financial editor Drew Parkhill joins us now. So, Drew, it seems to be almost unanimous. I've never heard of a 100% prediction that there's going to be a recession. What's your outlook?
Well, that model shows a 100% chance of a recession. Not all economists actually agree, but a majority do. I don't really pay as much attention, Gordon, to economists as I do what the market says, because the bond market, especially the government treasury market, that is your best indicator. So let's take a look. Now, a year ago, here's where the 10-year treasury bond had a rate of 1.65%. The 3-month treasury bill was at 0.05%. So there was a big spread. That's normal, because normally you have high interest rates at the long end. You know, like the longer you lend out money, you expect a bigger return. For just a short term, you expect a smaller return. That's the sign of a healthy economy. That's where we were a year ago. Let's look at where we are today, this morning. It looks very, very different. Right now, the 10-year treasury bond has jumped up to 4%, 4.1. The 3-month treasury bill has gone from 0.05 to 4.05, in no small part because the Federal Reserve is pushing up interest rates, pushing them up to fight inflation. When you see the 3-month treasury bill go above the 10-year treasury or the 30-year treasury, that's what's called an inverted yield curve. I know it's a fancy term, but all it really means is the economy is not healthy. Every time that has happened in the last 60 years, Gordon, every time that has meant a recession. We're not quite there yet, but the Federal Reserve is pushing interest rates higher, so we're almost certain to get there. So the market is telling us at least a slowdown is coming, probably a recession.
Well, the Fed is slamming on the brakes. I mean, I'm expecting another 0.75% increase at the very next Fed meeting. So is this literally days away that we'll see that curve invert?
Yeah, it could happen today. It could happen very soon. And there's a lot of concern that some economists are even concerned that the economy will rebound and then the Fed will push us into the recession that everybody's expecting. So it's kind of comical, because it used to be that only geeks like myself paid attention to the yield curve. Now it's out in the general media. But yes, everybody's looking at it. Everybody's watching it. So it's pretty widely expected that we're going to have that signal that a recession is coming very possibly next year, because it's usually about a year, Gordon, from the time it inverts till the time the recession arrives.
Well, anyone with a retirement account, an IRA or a Roth or a 401K is actually paying a lot of attention to this. I've been through so many crashes, whether it was the dot-com bubble or the 2008. To go through another one, no, my retirement funds are saying, no, you can't afford this. So for the average investor, should you switch into the short-term treasuries right now and wait out the storm? At least you're going to be making 4% on your money, as opposed to losing in a long-term stock valuation.
Well, everybody's financial situation is different. I mean, if you want to park your money in a whatever place you choose for a while, that's not the worst thing. But I mean, if you've been in stocks all this time, you've already lost a lot of money. And I can tell you that a lot of smart people, the ones that I pay attention to, there's not that many of them, but they're looking at some of these bargains in the stock market now. Some stocks have actually held up very well. What's really going on here is it's just the working out of the aftermath of the COVID lockdowns, okay? Because we have the worst situation in the world. We have a weakening economy, we have high inflation, we have stagflation, and we also have the uncertainty of how high interest rates are going to go. So the key word there is uncertainty. That's the one thing the stock market hates. But once we get through this, and it may not be, Gordon, until 2024, so maybe you could wait till then. Nobody knows when inflation is going to peak. Nobody knows how high rates are going to go. Nobody knows how bad this recession would be. But once we get through this in the second half of this decade, stocks are going to be extremely strong. So like I said, everybody's individual situation is different. Right now, the Dow closed, that was from earlier this summer, is 33,000, still over 30,000. But right now, the Dow's over 30,000. I think by the end of the decade, or within a decade, it's going to be over 100,000. I think the second half of this decade will be extremely strong.
That is a very bold choice. So,
I'm standing by it.
So hold on until 2024, and then it's pedal to the metal until the end of the decade.
Yeah, I don't know exactly when it will begin. I don't know when we'll have the final bottom, but I will tell you, everybody talks about the roaring 20s. That's how we remember the 1920s. The 1920s didn't actually begin until 1924. The first part of that decade was pretty bad. I mean, we had the Spanish flu and World War I at the end of the 1918, 1919, that period. Then we had a slower period in the early 20s. Beginning in 24 and 1925, the market just exploded. I think we're going to see the same thing this time. I don't expect a crash of 29. We'll have a bad bear market at the end of it, but that's normal. But we will have a very, very strong stock market in the years ahead.
All right. Well, if you can hold on in the meantime,
Yeah, exactly.
We all have to pay a whole lot more for the groceries and the fuel and the winter heating bills. So, Drew, thanks for your analysis,
Yes,
and
sir.
thanks for joining with us.